Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have David Skarica of Stock Chart of the Day and AddictedToProfits.net. David is going to give us his take on the economy and the current AI bubble. And we are going to pull up the charts on precious metals, commodities, and the companies and questions you submitted. David, thank you for coming back on the show.
Oh, thanks for having me.
Yes. Okay, let's get right into it. We'll start out like I always do. And what is your current take on the economy and financial markets?
Well, what's interesting is I've kind of done a 180 or a flip this year, because late last year, I was thinking that, the Fed is going to cut rates. And I was really bullish, and I've kind of remained bullish, but more tepid now. And I just thought the Fed was going to, cut rates, and because inflation was going to continue lower into the middle of the year. And we could almost have like a 1995 scenario where it's like a positive rate cut year. I know a lot of people think that now when they cut rates, because what happened in 2008 or 2001, 2002, that's bearish. But, there still is the old adage, they don't fight the Fed. And, in 2019, when they went from raising in 2018 to cutting in 2019, the market did really well. So the don't fight the Fed did work. Of course, after COVID, when they cut rates to zero and printed all that money, we had essentially a 2-year boom until late 2021. But then as things went along, I got worried about two things. I was like, well, inflation's coming down, but it's not coming down fast enough. Actually, three things. Then I thought there was too much frothiness in the market, especially in AI and tech. And the third thing is I started researching into a guy named Mark Osisko, who took over for John Templeton here in the Bahamas after Templeton retired. He posted Twitter that 17 trillion in debt has to be basically rolled over or issued between now and the end of the year. And I think personally, it's just too much supply for the market to handle. So I was like, you know what? I think that's going to put an upward pressure on interest rates. And no one's talking about that. They're talking interest rates about inflation or what the Fed does or whatever, but no one's talking about at some point, we used to have something called the bond vigilantes who would force interest rates higher to make governments stop borrowing so much. No one's talking about the potential of that kind of scenario unfolding where it doesn't matter what the Fed's doing. It doesn't matter what the economy is doing. If they keep issuing all this debt, and we're of course now above 120% of GDP on the debt to GDP, and now if you go look at the TLT chart today, we're actually getting back to the lows of we're only about a point or two above those lows, and the 10-year bond yield spiking higher again. So we have to ask ourselves, is this something that could derail the markets going forward? So I'm much more, and we're in the kind of sell and may go away period too. So I'm getting much more defensive now. I'm raising cash. I haven't really got to the point where I'm considering shorting yet, but I'm definitely getting there shortly. And I thought too, just last thing, that maybe we were gonna have this blow off, kind of like 29 or 87 into the summer. I'm more reluctant to think that now. It looks more like we're maybe topping right here, and tops can take a while to unfold. And I think one of the things that really maybe positive topping is when Nvidia had its earnings and Nvidia blew off. I thought that would maybe be the launching pad for this second blow off of the rally into the summer. But no, the Dow was down 600 points that day. And I was like, well, now maybe it looks like maybe these Nvidia blow off earnings are kind of marking the top of the market.
Yeah, that's interesting. I was in the same boat. I'm going to share my screen here. And so this is the CME tool. This basically tells you what the traders think is going to happen. The next meeting, June 12th, 99.1% think that they're going to pause. You go out to July, it doesn't get a whole lot better. 89. September.
I think it's November. So I looked at this like 2 days ago. Yeah. So then it's still 50,
Yeah, it's still north of 50% come September meeting think that they're still going to pause. And then another one too, I'll pull up, you just talked about it, is the TLT. Yeah, it's just, I would have thought by now they would have started cutting and we'd be making money in TLT, but there's a real risk of a sell-off here going down probably to this like low 80s level, right?
Yeah, and I think, just so you know, I think that oversupply issue is a big part of it. Because we always forget, like, 'cause we're looking at charts but what's the market dynamic is supply and demand. Like, one thing that always caused the bust in the dot-coms wasn't just, okay, they were bubbles and overvalued, but there was too much supply. All these companies started coming public, there was all those IPOs, and then all of a sudden it was saturated. So it's like, if you go, I don't know, to like a grocery store and there's like a handful of nice fillets there, they're gonna be expensive. But if there's 200 of them there, they're gonna have to get rid of them and put them on sale. So it really is that simple. And now we're kind of seeing this, I think, in the debt market, where what's interesting is, I don't know your age, but I'm 46.
44.
And I got into markets, in the early 90s. Even when I was a teenager, I got interested. And I remember all these books like Bankruptcy 1995 and The Great Reckoning, and you can go look them up on Amazon. And they're all about, and Ross Perot kind of ran on this too. They're all like, the national debt is too high. Back then it was like 4 trillion, right? And everyone was worried about this. And now the national debt is 30 trillion plus. And it's increasing, like, whatever, a trillion every I think they say 100 days.
Every 90 days or something.
Every 90, and no one cares because they've been able to suppress rates for so long. But here's another thing is, we know in the government, you talk about people behind the 8 ball, the people that are going to be most behind the 8 ball will be the government, right? They're still spending money like it's 2021, like rates are zero and, cost them nothing. And one reason that huge rollover, number 17 trillion roughly, is because most of their debt is 1 and 2 years. So it's just quick math. I just assumed that the average yield on that 17 trillion is between 1% and 2%. So that's like, whatever, 300 billion, you could say, in interest payments. Well, if now it yields 5, you're talking 800 to 900 billion. So you're talking 600 billion more on the deficit just in interest, like overnight.
That's tripling it, and yeah. Yeah, that's interesting, because the 17 trillion you're talking about, the total market cap of the stock market right now is what, like 40 or 45 trillion?
Yeah,
something?
so it's almost half the size of the stock market. Yeah. So yeah.
Okay. So, you touched on it a second ago with Nvidia. What's your current take on the AI, the artificial intelligence sector?
Okay, with Nvidia, even though, like I said, I'm a value investor, and I know we're kind of a dying breed, but I did not trade it because I thought that they were going to blow out earnings and rally again. And I was watching the chart into it; it was getting right back to the highs right before, and it just looked like the setup was there for a breakout. And part of the reason I thought this is that I'm invested in a very small AI company, is kind of a way to play it, out of Canada. And this small AI company bought Nvidia chips, right? And they did it in like February, March. And I just thought to myself, well, if this company's doing this, how many other companies are jumping on that bandwagon, right? Because now everyone's favorite stock is Nvidia. But I do think now, after these blowout earnings, and it's trading at 35 times sales, and the stock is super parabolic, that I think the next quarter is going to be really tough. This could be the final move here in this quarter. It's impossible to pick. But like, if you get an ultra long-term chart, like 10, 20 years, it's ridiculous. It's like the most parabolic thing you've ever seen in your life.
Oh yeah, here, I'll just zoom out on this. I mean, you can see. Whenever my buddies ask me, is what do you think of AI? I show them this chart and I ask them, does this look sustainable?
Well, I got bearish in Nvidia in 2021 because then most of their chips were for video games, right? And I was like, well, with COVID over, or 2022 in that bull, I was like, I did make money because it went down like 70% that year in 2022.
Yeah.
And I was like, well, with COVID over, people are going to be playing video games left. They're going back outside. They're going to travel again. So that's bad for their business. But they kind of lucked out. And the CEO of Nvidia even said this, that it ended up that the chips that they make for video games were the best suited chips for AI, right? So they were, like, hey, I bought my house at the bottom of the market. It's almost tripled in price, and I did not time it, so I lucked out. So sometimes it's better to be lucky than good, or smart. So, but if you look at the other ones like SMCI, or AMD's kind of gone up in that AI boom, they all look like they've blown off and topped. Like SMCI kind of got down on its earnings, and it has bounced back a bit, but it looks like Nvidia is kind of like the last man standing. And one thing I think that's unique to the current day bubble, as opposed to 2000, everyone wanted the next deal. It wasn't just Amazon or AOL or Yahoo at the time, the leaders. And then they wanted pets.com and the globe.com. I don't know if you know any of these names, but that they all came up. There were all kinds of these deals. Now I find that people aren't so interested in the other names. Just like they want to be in Microsoft, they want to be in Apple, they want to be in Amazon, they want to be in Nvidia. They don't really want to find the next one. They just want to be in the current ones. And I guess that makes the bubble more similar to that Nifty 50 era, of the 70s, when it was IBM and Kodak and those kind of companies. So I think like that's what's really unique is, and Nvidia's market cap is getting close to 3 trillion. You're talking about the economy. Like that means it's over 10% the size of the US economy. And being Canadian, it's basically Canada's economy is roughly 1/10. It's basically the size of the Canadian economy. So,
that's an incredible correlation. I've never put that one together.
Think about it.
It's incredible. Okay, what investments have your attention right now, David? Going into the macro that you just described, where are you allocating capital? What do you see?
Let me start by blowing, tooting my own horn. Remember, I was on. Basically, it was when Endeavour Silver EXK bottomed, and I talked about it at like 150. Yes. And again, I could see it was bottoming, but I didn't expect it to go up this far, this fast. Like it's up to like I think what, 450 or so.
$4.04.
$4.04. Okay, I follow a Canadian chart. So I bought it. I bought it at 2 Canadian because I do so much in junior mining. Sometimes I don't want to convert back to US because you get screwed. You get screwed on the exchange, even at your brokerage.
So I bought it pretty much right where we were talking. It was right here.
Yeah. It was right here. Yeah.
Yeah.
That looks like it's nearing some resistance. But again, if you go back and look at the stock the last 10, 15 years, you'll see that the rallies are very spiky. Yeah. They're like, so it looks to me like we're probably in the midst of one of these rallies that's going to take it to $6 to $10 a share. And the pullbacks will be very small and short-lived. So I wouldn't buy it right now, but like it had a little pullback a few weeks ago, like only small little pullbacks in it. I would definitely look at buying. And silver looks quite good and constructive because we just broke that key $30 resistance, which if you go look back in 2020, silver came down off that 3-4 times. And I think breaking that, you can see that's a clear breakout, right?
Yeah, right up here. I got really a drawn in right here at $30. And yeah, that was like, finally surpassed 11 years of just resistance.
Yeah, and then there's some at 35, but really, you're not talking about much until that 40 to 50, kind of like 2011 high period, it's so, and silver's a spiky trade. So, go look at that 2010 period when silver essentially went from, 15, 20 to 50 in a few months. I remember I got out at 35 thinking this has gone way too fast, and then it still went to 50, So I remember that time very, very vividly. So I like that. There's a small silver company I like, Disclosure. They're one of my sponsor companies on my on Stock Chart of the Day. It's called Aftermath, AAG. And they have a pretty there it is there. Aftermath. They have a pretty large resource in Chile, and it's a very leveraged play on silver. Yeah, I first bought it at 8 cents in 2019, and then it went all the way to 160. And then you can see, look at that again. Look at that beautiful base it's had since 2022, and it just broke out of the base. Yeah. And they have a large, like I said, they have a large resource. So this is a very good levered. If you're looking for a small cap levered play on silver, this is a good one.
I seem to remember trading this one a couple of years ago. I don't think I ran an option on it. I think I just bought straight up shares, but
there's no options. It's a Vancouver stock. So like it's DS Ventures. So.
Oh, okay. Yeah. Okay. Yeah. Yeah. I remember this one. Yeah. It was an optionality play. Okay. Interesting.
Yeah. So if you don't want to trade options, I think something like this is the way to go because you're getting a leverage play, right? So like if silver were to go to 50, now there's a lot more shares outstanding now. than there was in 2020, 2021, because, you know, these companies always have to raise money to drill, et cetera, and they dilute. But, you know, if silver goes to 50, it should go back to, say, that 150 high.
Yeah,
You know, so
yeah,
you're
that's probably
talking
a triple.
a 50% rallying, silver, and this is a triple. So, you know, it's pretty good.
Yeah,
So,
yeah.
you know. And
Awesome. Okay.
I still have call options on the SLV, and they're December's, and I'm holding them. So,
Okay.
you know,
Okay. Cool. Yeah, you like the longer dated call options, though.
and I'm not smart enough to know if something's going to go in 2 months.
Me neither. All right. Can you share your screen and we can just pull up some? We'll pull up the gold chart and tell us what you see.
1 second. Yeah, here we go. Yeah, okay, here we go. Yeah. So if we look at the gold chart here, you can see this won't include today's action because this is gold. I can just get GLD just to quickly get today's action. But yeah, see gold's down a little bit today, giving back some of yesterday's gains. I don't know. It does look like a bit of a consolidation still. You know, we had the big, like really that big reversal day back in April is still kind of, has been kind of the high, right? Like we went back to it and then we sold off again. It looks to me like we're in this phase because again, if you look at the gold to silver ratio, and I'll quickly put that up, it was so historically high, when it was in the 90 range, and now we're like the 73, 75 range. It looks to me we're in actually a phase where silver is outperforming. So I would think that, I don't know if gold can continue this consolidation or go higher, but I would think that right as of now, it will probably continue to underperform silver for like a 3, 6, 9 month type period, right? So my worry about gold is being, talking about the stock market and kind of worrying about the market is that, if you get kind of a sell-off in the market, that can often hit gold and silver as well. Saw that in 2020, saw that in 2008. Even near some of the lows of 2002, you saw the gold stocks kind of get flushed out when the market was kind of doing that bottoming formation. So that would kind of be my worry, that if you say it got a 20 to 30% drawdown in the stock market, that the gold for the short term could sell off. But here's the deal with that. That would finally get the Fed to loosen. And I would think that gold and silver would be the two assets that go back to all-time highs the quickest when that occurs. That kind of happened in 2008, 2009, that when the Fed loosened after the financial crisis, gold and silver were hitting highs, like 52-week highs way before, the market didn't go back to its pre-financial crisis highs, I think, to like 2015. So like I think they would probably lead the way out of here. But right now, I don't know. This still kind of looks like a consolidation. And we had a huge move from February. We went from 2000, we went up 20%. This is a major commodity. So that's a huge move for gold and silver. So, and the seasonality of gold and silver, this is kind of the weak seasonal period going into the summer, September, and then it kind of picks up into end of the year. So maybe that will play out as well.
Okay. Yeah. And in those sell-offs, like you're talking about, it was a pretty quick V-shaped recovery. Whereas if you look at other companies, they had a long drawdown before they finally came positive.
Look at the stock market in 2020. Again, early on in a loosening cycle, gold and silver performed the best. And if you go look at 2020, they had a V bottom, right? I'll get gold and I'll just get a longer term chart so we can look at this. I'm gonna get a 10-year chart so we can see the V bottom. Yeah, you can see that little V bottom right here in 2020. Actually, I'll get a 5-year chart so we can see that even better. Gold was actually going higher into it, right? Yeah. And then there was that V bottom. You can see, by May, gold was already hitting new highs. And if you go look at the stock market, the S&P, took till the fall to hit new highs. Yeah. So, and that was still a pretty quick recovery. But again, and a lot of companies that fell like really hard, 60, 70% during that COVID correction took maybe a year or something. So again, gold and silver tend to lead earlier on in the loosening cycle. And 2009 was really a part of that, because gold by the summer was breaking out to new all-time highs. And the S&P, of course, was nowhere close to its all-time high. Yeah. In the summer of 2009.
Okay, let's pull up silver.
Okay, so I'm gonna put. Oh yeah, silver actually. Just so you know, I bought SLV calls again. Not all trades go this well. In 2000, so look at silver. When they had this dump, the gold to silver ratio hit something like 120 to 1. It's like all-time low.
Yep.
So I bought SLV calls at that time. And I think I bought calls on a couple companies. I think First Majestic I bought calls on as well. And because I was just like, yeah, the silver's the play. And again, you can see silver busted out to these highs way, way before like the S&P or NASDAQ or whatever did, right? So it's for whatever reason, early on in these loosening cycles, precious metals tend to do like very, very well. And again, if you go look at 2019, so we'll just get a 6-year chart now. So we can see 2019. Remember, they started to cut rates in 2019, about middle 2019 after, the tightening in 2018. And again, gold and silver did exceptionally well. You can see silver rallied from just over 14 to, close to $20 an ounce. So again, early on, especially that first 3 to 6 month period in those loosening cycles, even if you look at 2016 when precious metals came off the lows, and that was like the lows of the cycle, gold and silver did great in the first 6 months of 2016 because the Fed basically was going to start raising rates, and then the market had kind of a couple tantrums in 2015, and they took their foot off the pedal. It was election year too, so that probably played a part. But and then gold and silver did great for that first 6 to 9 month period of that. So I think what happens is people are still more defensive early on in bull markets, early on in the Fed loosening cycle. So they're still attracted to the precious metals. And then the one reason they lag as that bull market matures is then people get greedy, right? They want growth, they want tech, they want AI. Like in 2014, the bubble was 3D printing. They want these kind of things, right? They don't want to be in boring gold and silver, as the bull market matures,
So what pattern do you see it trading here in the near term? Is it between 30 and 34, or do you think we could get below 30?
I would have a tough time to think, again, if we see a bad sell-off in the stock market, it might get below 30, back to 27, 28. But if we can kind of see silver continue this breakout going forward, to like you're talking about 35, I think that 30 is going to hold. Because again, you look at that chart, look at all those attempts in 2020 and 2021 at 30. It's such big resistance. It should be pretty big support. So I would think that. So and like I said, I think at some point, and this happened in 2018, you can kind of see it in 2018. I know it doesn't look much, but this little tick higher here, the stock market was still falling. The markets were still falling, but gold and silver were starting to anticipate that the Fed was going to stop raising rates and start cutting them. So I think that even if they did initially sell off, what will happen is at some point that sell-off is going to change what things that you just showed earlier, those Fed fund futures outlooks and outlook. And if I'm right, and those bond yields start spiking because of the amount of debt, that's the ultimate end game, because that means more monetization is coming, more QE is coming to try to keep those rates low. Because let's face it, with the government's current debt load, you can't have rates of 6, 7, 8% anymore. They're going to be broke. That interest payment will eat into too much of the budget. So they'll be forced to print money to keep rates low. And then there's all kinds of other factors too, like because where housing prices are, again, those higher rates would basically make housing completely unaffordable unless housing prices just out and out crashed, right? So so there's, and they don't want housing prices to out and out crash. So there's all those other factors as well. But I'm hoping like I'm to the point where I did talk about aftermath, but other than smaller plays like that, and everything trickles down from large, medium to small, in a bull market. I'm just kind of holding the positions I have. Like, luckily, like I said, we showed Endeavour. I was also buying something called Fortuna FSM in my publication. These have had huge runs of 100, 150%, 200% in just a few months. So I'm kind of holding. I haven't sold a share of EXK yet, but I'm also kind of just I'm also not buying. Like I would only buy more if we had a flush out, like kind of like what happened in 2020. And I don't think it's gonna be like 2020. You can see 2020 broke the 2018 lows.
Mhm.
I don't think we're gonna have that. 2020 is a very unique kind of crash because it's not an economic crash or just a one day phenomenon like 87. It was the whole global economy basically stopped for like a couple months.
Yeah, that's something I don't think anyone could have anticipated. Our
Yeah, I
big
don't think
thinkers
it's ever
doing
gonna
a
happen
policy like
again.
that. Okay, how about the oil chart?
The oil chart, I don't know. It's just like kind of in a range, like that could be a basing pattern, or could we maybe fall again if the stock markets go down, we enter a recession, oil could sell off. I think one thing that helps oil is the strategic reserve selling is basically done. They've stopped that.
Yeah.
And even in an election year, because they just tapped it out too much. And no matter who wins the election, they're going to have to start replenishing it. So all of a sudden becomes an issue that was supply and too much, and driving down prices or helping keep down prices to demand, and that helps kind of prop up prices. So I think that kind of helps oil. And I think a lot of the move from 78, and I've said this in my publication, to about 88 was a war premium when in the Middle East, when Israel and Palestine and then Iran had that night of bombing. So I think some of that came into the market, and now that it hasn't really escalated, that's kind of come out. And of course, we're entering the summer driving season and all that sort of thing. So I'm still kind of neutral in oil. Again, the positions I have, I'm holding. I actually would hope that a recession could take oil back to, I don't know, that 68 level that was like the lows.
Oh, that would be beautiful, wouldn't it?
That would be beautiful. I would love that because I would love to add to oil positions. But right now, I'm kind of just in a holding pattern. And another issue with oil too on the supply side is the U.S. right now is producing 13 million barrels a day, at the highest amount of oil that anyone has ever produced in a day, any country ever. So, and that's with a kind of energy unfriendly administration. So let's say Trump won, like he's going to even look for more drilling. So that would definitely, that's another a thing about it. And all those the frackers, when they were first kind of booming back in the early 2010s, they needed about $90 to $100 oil, but their costs now, the technology's gotten better, have come down. They only need about 65 to 70 to break even now. So that's, again, probably why I would never go much below that. Barring some kind of crash in the economy, but also it means like you can maybe somewhat have a little lower prices because these guys are profitable at these levels. And same goes with Russia. Like Russia, they're still selling oil, even with the sanctions, and because the rubles come down a lot, when they convert those U.S. dollars to rubles, they make way more money. And so again, Russia can make a lot of money at $70. $80 oil type thing. So, and there's still a lot of demand from Asia as well. So, yeah, right now we're kind of in the middle of this range. Like, I'll get a 2-year chart. I don't know. It's just tough to tell on the charts. Is this just like a huge base? Going back to 2023 between 65 on the downside, about 85 to 90 on the upside, or is this a consolidation for a move lower to maybe a washout to what we're saying, again, another move to 65, or maybe even break those support levels. So it's tough to tell at this point. So, but what I really like longer term, I like the Canadian oil producers like Suncor. There's a little one I own called Athabasca, ATH. And the reason being is, again, the Conservatives are almost definitely going to win next year in the Canadian election. And if Trump wins, those pipelines will be built, and that unleashes all that Canadian oil from the oil sands to, they're producing near record levels too as well. And that's with having to truck most of it out or put most of it on trains. But they have that pipeline, then they can really unleash the production.
Yeah. Okay. How about natural gas?
Natural gas, I actually talked about. The problem with nat gas, there's not a lot of pure plays on it other than futures. But I actually started around $1.60, $1.70, turning bullish on it. It's not being it's just I like stuff when it's down 80, 90%. That's just my personality.
Yes.
So, back then natural gas had kind of washed out. And I bought Enbridge, but that's more of a pipeline company right? It does benefit, obviously, they make more money. Their margins are higher when prices are higher. So that's helped. But natural gas looks quite constructive here. We had a really warm winter, so that obviously reduced demand. And that paid a big part in that, that moved down from 350 last October to 150. But El Nino, I follow all this stuff because I live in the Bahamas, and obviously hurricane season's coming up. So natural gas, now if it's a hot summer, that's more demand because people blast their AC and etc. And what's funny, people always forget about that. I think people always think heating oil, natural gas, it's a winter play, right? But a hot summer, or more people, because in the winter, people where I live, like I don't use my AC from November to like April, but I have to use my AC in the summer. So people who live in Florida or live in, Arizona, they might not use a lot of energy actually in the winter, but in the summer, they're going to use it. Plus, people in the Northeast are also going to be blasting their AC. So we could get more demand as well. And if you go look at that chart, again, if you kind of go through that 350 area, like that was such a steep decline in early 2023.
Yeah.
I don't know if we'll go straight back to 7, but you could go back to $5 or something like that. But again, it's very difficult because there's almost most companies that produce natural gas also produce it as a offshoot of oil. There's very, very few, just like it's kind of like trying to find a pure silver play. Most companies produce silver while they produce gold. Obviously there's some, but it's very, very difficult other than say just trading the natural gas ETF or buying the futures or options on the futures or whatever. So
Okay. Let's pull up uranium.
Okay, 1 second. Is there uranium? You might have to pull that one up, if that's okay.
Oh, okay, sure. I'll pull
Yeah,
that
because
up.
I'm just on stock charts, so I'll stop my sharing right now, so you can pull that up.
There we go. And share uranium. Okay, here we go. All right, so we had a heck of a run up here, which was amazing if you were invested in uranium. Had a little bit of a pullback. Now we're kind of settled around $90 or so. Are you into any uranium stocks?
Right now, like actually one question you had, someone was asking about UUU.
Yeah.
Yeah, I own a little bit of that one. That's about it.
The energy fuels?
Yeah, energy fuels, but it's not a pure uranium play. I actually think they should spin off. It does like it's really an alternative metals play.
Yeah.
And it's a good company. It's kind of lagged, but I think the first time I talked about it was in this one account we got in at $2-3. I was like near the lows a few years ago. I found it for years.
Oh, nice.
Right. Yeah. But like it trades at 9 times earnings. It's a cheap company. They're putting in a bunch of production of these other properties. But what I would think that would be better for them to do is to, basically spin out some of the alternative energies into a new company. Because I think the problem is when you have a deal like this, everyone right now is interested in uranium. They don't care about rhodium or all these, weird metals that you might be producing.
Yeah, they got into the rare earths.
Yeah, the rare earths. I think if you spun out the rare earths and you would just get the full value of that uranium, the uranium stock would probably go higher, and the shareholders would be happy because you get stock in the new company, right? You get, because the way they would do that is you wouldn't have as many shares outstanding because you would basically get like half your shares in UUU and half your shares in the new company, right? So that's what I would like to see them do. But chart wise, it kind of looks like a silver stock, right? Like you've got like that EXK chart. You've got that support that it's coming out of, and maybe it's going to go back to those highs. And like I said, it's really cheap stock. It's trading at like if you go look at it, it's trading like 9 times earnings. Yeah. So that answers one of the questions we were going to do later, but
it did. Well, while we're on uranium, you want to pull up Cameco, or I could do it here?
Yeah, we pull up Cameco.
Okay. On your chart?
Look, you know a lot more. I've seen your podcast or your streams. Mm-hmm. You know a lot more about, or you're a lot more invested and interested in uranium than I have been. But I always like my issue with uranium because I did a lot in 2005, 2006 when uranium was a huge bubble, and there were all these uranium juniors. there were companies like Denison, Strathmore, and then these, I think Mega Uranium, which is still around, you know. And my experience was, with all due respect, most of the uranium juniors were pretty crappy companies. They were just getting into it because it was the hot market. None of these things were ever going to really go into production, et cetera, et cetera. It's like when a lot of these mining companies in the late 90s became .coms, or they became crypto in 2017. So my feeling all along has always been, if you're going to be in uranium, just buy Cameco, right? Because that's the top tier company. That's the largest company. I've known about this company for 20 years. It's a very well-run company. Now, at these levels, I wouldn't be chasing it at all. But if there is some kind of pullback, I would, like what happened, like even the smaller pullback, like what happened in February, March.
Yeah.
I would definitely
April. There's March.
April. Yeah. Definitely look at buying Cameco on those dips, because if uranium goes north of $100 again, at some point they're going to start basically printing money. So this would be my stock of choice. Again, I think you should have bought it probably last March if you're going to buy it.
Yeah.
See from the chart there. But I think that this is my company of choice. And I hate to not be as sexy, but I like UUUU. It's a cheap company. But my experience in the uranium market is the smaller companies aren't that well run. And I've done a few junior plays. None of them ever really, worked out. Strathmore was pretty good when it was around, because the CEO was a pretty good CEO. But like for the most part, it's just like, especially when you're in a very small segment of the market, like even, I talked about EXK, but really, if you're really just going to buy one silver stock, you should probably buy First Majestic or Pan American or something like that, right? Buy one of the larger good companies, because not everyone can, like, I don't know how big people are into uranium, but do you really want to own 10 uranium deals? And if you're someone that say got a small amount of money to invest, you're like, I just want uranium to be a few percent of my portfolio on one stock, this would be the stock, in my opinion.
Yeah, but I see the same thing you do. Like when we're up at this end of the chart, I'm completely uninterested. But when we're down here hitting on the 200-day moving average, that piques my interest.
Yeah, buy the dip, sell the rips, as they say. That's what you want to do, so.
All right, and Ryan wants to know about Silex. This one I wasn't familiar with. Do you see anything on the chart here that makes you excited?
This thing's way too overbought for me. It's even like, I look back to it I was looking at what they did, right? And I was looking back to 2020, and this thing was way lower. It's an Australian company, right? And he said a bunch of news is coming, but look, that's the one thing you got to really stray away from in bubbles, because the news is always the best at the top, right? Yeah. And okay, like things can always go higher. Like Stanley Druckenmiller, he sold, Nvidia at $900. And now it's 1,100. But like, you're never going to get the exact top. I don't know if you know Jesse Livermore, the famous trader. I think
I've seen videos on him.
Yeah. So he used to say that the toughest part of the markets is the first eighth of the bull market and the last eighth. And you're never going to get each exactly. So again, like you look at something like this, and I don't know what I was reading about what this company did, but I don't know how well known it was back in 2020, but it was $1. Now it's $20. I just would have especially with my opinion, we're being late cycle in the markets. I just think you would want to wait, because even look at 2022 when we were in a bear market, you had that spike there and then kind of consolidated before moving higher again. So I would wait for at least one of those consolidations. It's an interesting chart,
like a pullback down to here or something to capture some of that resistance.
Have these huge spikes followed by these big consolidations, and then another spike. It seems to do it over and over again. So, but yeah, I wouldn't be buying this here. I would just, hey, and if you're lucky enough, like I said, to buy it at 510, take some profits and just be patient. Yeah.
Okay, and then I love this name. Fiat is Dead wants to know about base load energy.
I just looked at the chart because you gave me a whole bunch of these and I didn't have a lot of time. So again, I'm a contrarian, and this is kind of lagged, the markets, you can see.
Mhm.
But I was looking at the chart, the all-time low is basically 30 cents. You know, it's like 32 or 33 or something now. You can just buy it and do a stop loss at 30 and just see what happens, you know? So, and the one thing about these long basing charts, you know, the old saying, the longer the base, the more the space,
Mhm.
they can be boring for a long time. Uranium was like that in like the mid 2010s. There was no reason that anyone had to buy it after the bubble burst. But if you had bought it and even you had nothing happen for 3 or 4 years, like 6, 7 years later, now, like Chemical, for example, you'd be up 5x on.
Yeah.
And I think anyone would take a 5x return over 6 years, you know? So with something like this, I would just wait and I would just buy and wait. But I don't know. I'd have to look into it. I don't know enough of the fundamentals, but from a chart perspective, it's boring. You might underperform for a while, but maybe at some point it has a big move like it did in 2021 or early 2022.
Yeah, these charts actually kind of get me excited, unlike the one that we just looked at where it was screaming up. This one looks boring and like a dying heartbeat. And that's kind of where I take the attitude like you, like, okay, I'm just going to throw my hat into here, expecting that it could take 3 to 5 years, but when it goes,
It's
you
going to
got
go.
a lot of room to run.
Yeah, I remember because like I got started in the precious metals in the late 90s, and Eldorado was like that back then. It was like a penny stock, right?
Yeah.
They did a reverse split years ago, so he doesn't look it, but it was actually 25 cents at the time, and it had come down from like $6, and it was just sitting between 25 and 50. And then in the next cycle, it went to like 20 bucks. You know, so it's just like it's like, yeah, sometimes it's like everyone wants to chase AI, everyone wants to chase that hot thing, but sometimes just waiting for these huge bases, like even look at Amazon. Amazon after the bust in 2001, it was dead money for like 10 years. You know, it did nothing for 10 years. And then, you know, look what Amazon has done from 2011 till now. So it's sometimes you have to do that. A lot of people just think that Apple was easy money too.
Yeah.
Apple was below its IPO price in 2003. It was 20 years later. So like, you know, you never know when these things, you don't even see that consolidation at Amazon anymore because it was so low. But yeah, from really like 2001 to 2011 to 2012, Amazon did basically nothing.
Yeah.
You know?
Yeah. Just went sideways. And look at it now. Okay, let's move on to gold. Pete wants to know about Gold Royalty Corporation. Have you followed them
I
at all?
looked at it. The stock had a big gap down, and it was because it looks like they did some kind of large financing at a bit of a discount to the price.
Yeah.
And oh no, so that's another one. No, they did a lot, just did a large buy in financing too. Actually, two of them that you gave me, I both did large financings. And first of all, royalty plays are always look like everyone knows Royal Gold and Franco-Nevada, but they're very difficult companies to build, right? Because you have to raise capital and then invest it wisely in the proper projects. So Franco-Nevada and Royal Gold have done it perfectly, you know? But then there's all these other smaller ones where it's difficult. And like I said, they had to raise capital and dilute. That's why you saw that gap lower. And that's something I have to warn people about the precious metals industry in general is, you know, one reason that Amazon and not so much Amazon, but Microsoft and Apple have done so well, these companies buy back stock. Like if you go look at the number of shares outstanding in those companies over the last 15 years, they've gone down.
Yeah, the share count has
shares
decreased.
outstanding, outstanding in gold mining companies always increase because they usually have to raise capital to finance projects, to finance new mines, etc. And that's dilutive. Like I bet you if you look at something like Barrick or some of these things, their market caps might be as large as they were at the 2011 top because they've issued so many more shares. So that's the thing you always have to take into account. I don't know enough about their projects. I can tell you, I like a company called Sandstorm.
Oh yeah.
Yeah, that's a mid-tier royalty company. So that's kind of my royalty company of choice if you're not going to go into Franco and Royal Gold. And it's kind of been creeping higher, right? So, and one thing Sandstorm did is, so you ever want a company to take on too much debt, but they did do some debt financings, which meant that they didn't have to dilute like that. you know?
Yeah.
So that's always the advantage when you can use debt, because, especially when debt was cheap a few years ago, that you don't have to dilute to expand your royalties and production. So I would say like that company, I'll have to look more into it, but I would just say that big gap down on that big financing is always the risk you're taking in these mining companies. And a lot of times, when the markets have gotten good now in mining, they want to take advantage of that by being able to raise money. Because sometimes in these poor markets, like last year, they can't raise money.
Yeah. 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 They bought a copper royalty and they had to dilute to do
Another
it.
dilute to do it. Yeah. So
I was telling a listener, I was like, man, I wish they would have, I wish that deal would have been available when copper was $2.50 instead of $5.
well, again, that's the problem mining too, is that now they can get the financing because the markets are better. And yeah, like if you tell someone, like, well, you said when copper was 250, hey, man, can we do a financing down here? This is great. And then everyone's going to look at you like, no way, you can't make any money doing it. Then people yell at these companies, well, why did you buy that at the top of the market? It's because they'll say, because that's when we could get the money.
Yep. Okay, Bart wants to know about Lion One Metals.
This is the other one I was talking about. They kind of did the same thing, back then.
Yeah.
See that? They did a financing. It was like a 50 cents, and it was at a discount to the price, and it was quite a large thing. I think they raised like $12 million. Which for that doesn't seem like a lot of money, but for these little mining companies. So again, I'd have to look into their project, but I think the issue is, and again, I kind of like the stock now. It's kind of,
it's only 87 million market cap.
Yeah. So and 12 million would be at 50 cents. That's 25 million shares, right?
Yeah.
So like basically, and 87 means they haven't. So that's basically 20% of their shares issued were done in that little financing. Yeah. So essentially, but I do kind of like the chart here. It's kind of been basing ever since that financing. Yeah. So so maybe that's the kind of thing, once it absorbs the stock that's going to come out in the financing, that it can start to move higher if the project is good. But again, this is a kind of another warning that this is always the issue in mining, right? Where like one thing I've been looking for now, I'm looking at these super micro cap juniors. I got one that's it's got a $4 million market cap, and it's got a 3 million ounce resource. Right, because they only have 9 million shares outstanding. So that's the kind of thing I'm looking at, because especially if they get some promotion and marketing in the company going and some drilling, it's like these things can move from 30, 40 cents to $2 easy in a bull market, because there's no shares out, et cetera. So again, that's another warning. And again, it becomes like a catch-22, because these companies have to finance so they can properly drill, properly build their resource. But sometimes when they do, that really kills the stock, because a lot of times what happens, some larger investors sell the stock to put it in the financing because you get a warrant, and when the 4-month hold comes off, a lot of that stock can hit the market as well. So but I like the chart here. It looks like
it's kind of putting in a basing pattern.
It looks like it might have to do that. It might have to do that a little while longer. And of course, another issue is because it dumped earlier this year. Like, you could get, if it doesn't move by the fall, you could get tax loss selling in this thing too as well.
Yeah. Okay. He also wants to know about Osisko mining. Do you see anything here?
I think that looks like it's coming out of a base. But one thing that kind of worries me about this, I know this company, this has been around a long time, is its big move was actually back in 2016 when we came out of the bottom. Okay. And it seems to have kind of lagged since. It did have a good move, you can see there in 2021. Yeah. But you can see it's still below the 2016, 2017 highs.
Here it is, right there.
Yeah. So I would just be a little worried about this, because it seems to have been a laggard for quite a while now, for 6-7 years. And I think, look, you have to own a basket of these things, and you never know when something's going to go from being a laggard to outperforming. So maybe just kind of hold a little position here. And again, it's kind of got that nice, like, boring base chart. It has kind of broken some of the short-term resistance. So I would hold this here, so.
Okay. Okay. And let's move on to oil and gas companies. Tile Brick wants to know, since we're going to oil. If there's a minor slowdown in the U.S. economy, would oil stocks be a well-timed investment?
Yeah, I think so. I think that if you got, like we just talked about earlier, that decline to 65 or lower with, and I never like to trade on politics, but again, if you look at the US producing 13 million barrels a day in an administration that's not energy friendly, like imagine what it will do if, like I said, like the Republicans take over. So I would definitely think that especially with the problems in the Middle East and obviously the sanctions on Russia, the U.S. is going to want to become even more, energy independent going forward. So I would definitely think, yeah, oil and gas could do, it would definitely be worth buying. Like the issue with the big oil and gas companies, Exxon's and Chevron's, they make just as much money selling you a candy bar or a bad hot dog at the gas station as they do selling oil and gas. But definitely, like Halliburton, Schlumberger are always good leverage plays because they always kind of, if you look at their charts, they're wild. They'll totally tank in the sell-offs and then do great. And it looks like there's a lot more offshore drilling going on now. So offshore drilling plays would be good. Like I said, I like the Canadian oil sands plays because if the politics sets up where they can really expand production, like they're already near record production anyhow. So I think that would really help as well. So yeah. And I kind of like the domestic plays because I do think that because of geopolitically, it's like just kind of like they're bringing a lot of chip production back home to the US. You're going to see that people are going to want more production as well. And also, like we talked about natural gas, one thing I think is going to help natural gas, goes with uranium, is that's the cleanest burning fuel. So especially with always the war, the worries over climate change and the whatnot, natural gas, you'll see a shift, I think, more to that, when you're shifting away from coal and stuff like that.
Okay, and Sam wants to know about the natural gas play, Equitable. I'll share my screen here, and there we go, EQT.
Yeah. Like, first of all, this company has really held up pretty well when you consider where natural gas has gone, right? Like natural gas is back to those 2020 lows.
Yeah.
And where the stock is. And it actually shows you that market price action can often mean a lot, not just the commodity. Because, look where the Dow and S&P were at the 2020 bottom compared to now, right?
Yeah.
Without a big sell-off in the market, this thing has been able to hold up. But yeah, actually, now that I'm looking at this longer term chart, that looks quite constructive. Like that we could just be that huge move that was higher.
Yeah.
We could be like one reason this thing peaked years ago was in the double digits, right? So, but yeah, this looks pretty good to me. Like I would think that you could maybe use that prior low as a stop loss and just buy it. And maybe this, now that natural gas is bottoming and could move higher into the summer, you could make a charge at those highs at the very least. And if you look at those highs, again, you got quite a resistance level up there.
Yeah.
You could break that and then go back to those highs back in, May, September.
Okay. Yeah. Yeah. Okay. So yeah, not much. You're saying use this basically down here as a stop loss, and then your next resistance is up here, and then beyond that up north of $50.
Yeah, and if you're like really bullish on it, you could use maybe that early 2023 level as your stop. Like a little lower. But yeah, I would definitely do that, and then hopefully if it would break that like that late to mid to late 2022 highs, it would maybe break out.
Okay. Okay. And he also wants to know about APA Corp. Do you see anything on this chart?
It looks like it's near breaking down, to be honest.
Kind of looks it's either going to do a double bottom, or with this bar right here today. This chart's at risk of breaking down.
Yeah. I would watch this one because those kind of charts, like the thing is, when you look at the shorter term chart, you're like, oh, that's the bottom. But when you scrolled out, it's like, no, the bottom's a lot lower a few years ago,
Yeah.
2020, obviously you don't want to take that because that's a crash. But you look at some of those 2021 levels in it,
Mm-hmm.
Like it looks like it can move back to there if it breaks down. But that's the kind of thing you could put on your radar screen, that if it does sell off like that, that's when you want to buy,
Yeah, yeah, somewhere around here. I mean, it could go down by 50% if it hits where it was in 2021.
I just don't like it when you keep getting those failed rallies like it had in
Yeah,
2022 and 2023, and you're
yeah,
coming back to these lows, and then at some point those lows just go.
yeah.
I remember that was kind of going on in gold and precious metals. Sorry, my glasses fell off. Gold and precious metals back in 2012. When they had this like pullback off the 2011 highs, and they were bouncing. Then in 2013 it broke, and it just like the dam broke, and all the gold stocks crashed in the spring and summer of 2013. So I'm not a huge fan of this kind of chart. I would wait for again that kind of mid 2021 level if you're going to buy. And like I said, you've got a series of lower highs here on these rallies.
Yeah.
So the rallies have like it's like you're so close to being stopped out. Maybe you could just buy with a very, very, very tight, 3%, 5% stop loss. But I just think that doesn't look good,
Yeah, yeah. I see the same thing. And Civitas Resources. I hadn't heard of this one. There we go. You see anything on the chart here?
That looks like a choppy uptrend. Again, charts like that don't interest me much because you've had the big run and it could continue to chop higher. You could, if you're trading in and out, again, you could buy the dips and sell the rips. But right now, that doesn't look overly enticing to me, either as a short or a long,
Okay. Okay. All right. And last one, Talos Energy.
It kind of looks like that other one you just showed me. Like that looks.
Yeah, lower highs.
Lower highs. You're right there. You could buy with a tight stop loss. And like that one actually looks like it could go back to the 2020 lows, to be honest. Like that.
Yeah, it's pretty close.
It's pretty close. But like, here's the thing. Actually, I did an interesting update on stock chart of the day. And I talked about these past stocks and cycles when stuff had done like really, really well from the bottom.
Mm-hmm.
And I said, one thing you should actually look for is companies that have been weak for a number of years. And then when there's a bear market, they really smash and then they're totally beaten up. And then when you turn the bull market, they actually lead out of the bottom because they're so beaten up. Like the perfect example is Tata Motors. From 2017 to 2019, Tata Motors, the Indian car maker, it had gone down like 40, 50%. And then by the 2020 bottom, it was down 90%, right? It had gone from
what's their ticker?
It doesn't have a US ticker anymore. They only trade in India now. It was Tata. Yeah, but you can see it there, Tata Motors.
Oh, there we go.
That's the Indian ticker if you want to get it. It's still good enough. You'll see it. So adjusted for the US price, because I know the US price, that was a $50 move down to like 10 and then 5 at the bottom in 2020. That's the equivalent of $100 US right now. So that's gone up 20x. And that's Jaguar and Land Rover right there. Like this is a big company, right?
Yeah.
So like that's kind of what I see in some of these other companies you're showing me, that if those are so beat up that if they get flushed out in a big market sell-off, they're probably better buys than the stuff that just came off the top, because now they're so beat up they could lead the way out of the bottom, so
yeah. Awesome.
There's no way I'd be buying Tata here. So.
Okay, yeah, it looks like it's almost as bad as Nvidia.
Yeah. I just want to do one more screen share.
Oh yeah.
It's actually, I'm just going to show. So this is an interesting chart. So this is like this is through stock charts. They used a site called Decision Point, and then stock charts took them over. So what I wanted to show in this is the percentage of stocks trading above their 20, 15, 200-day moving average. So this is a sign of breadth and strength. So what's kind of worrying me right now, especially on the 20 and 50-day, you can see we're downtrending here, since earlier in the year. Oh, yeah. And usually breadth peaks before the market averages. So, definitely look like, we're at a new all-time high, and basically less than 50% of stocks on the S&P are trading above their 50-day moving average. So that tells you fewer and fewer stocks are participating in the rallies, and that almost always happens before market tops. You know, so you know, you can see like the 200-day is slightly downtrending as well, but like look at that was really downtrending all year in 2021, and then the market topped at the end of 2022. So this doesn't have to mean an immediate top, but often this means like you're within 2, 3, 6 months of a top when this is kind of downtrending. So I would be really wary, and I think that's one sign that essentially we could maybe potentially be topping here, right? And I guess another thing I'll just put up quickly, because you know I talked to you about this off air yesterday, is these are the Dow Jones transports. They're getting killed today because American Airlines had bad earnings.
Yeah. And
you can see they're right on the cusp of breaking down. So we're also kind of in a Dow theory sell signal, because the Dow transports actually never went above their 2021 highs. And you can see, you know, really peaked last December, and now we're rolling over. And the Dow theory, for those who don't know it, basically says that the industrials have, you know, confirmed the price action in the transports. And you can see the industrials been making all these new highs, and the transports were. And this happened in 1999, if you don't mind me just quickly showing this.
No, please.
Yeah. So in 1999, and despite all this technology and AI and the whatnot, let's face it, the transports are still the real economy, right? Trains, car rentals, airlines, so travel, you know, travel and transport is still a huge part of our economy. You know, like most of the oil and gas in the United States still moved by railroads, not pipelines, you know, so which is why Warren Buffett, by the way, always opposes pipelines, because he's invested in the railroads. So, you know, but anyhow, you can see, okay, so this was the Dow here, and you can see the Dow hit this new all-time high here in 2000. Mm-hmm. And if we go look at the transports, you'll see they actually topped way back here in July of 1999, and in March of 2000. If you remember, that's the Nasdaq and S&P high. Yeah. You can see that was a huge warning sign that the market was about to enter this huge bear market, and of course it did last for 2 years, right? So I would say that's a big warning sign, and that's not a short-term indicator, but I think that's something now going out, you know, a year, 2 years, is telling us that something's definitely wrong. And if you want to just quickly look at the stock today, is American Air. Oh, actually, what's American? Sorry. AAA, sorry. Yeah, you can see it's down 15%. You can see that's a huge gap down today, American.
Oh, wow.
So, yeah. And actually, I think Expedia had terrible earnings, and so a lot of I think in retail stuff like Lululemon and Target had poor earnings. So I think you're really seeing the signs of an economic slowdown, and this kind of strength, you know, in the Magnificent Seven or AI is kind of hiding that. So I think that's a real warning sign, and that's why I think I've decided to get more defensive as well. And I do believe in seasonality. You sell in May, going away, and like, what am I really going to miss for the next 4 or 5 months? Maybe the market goes up 10%. That's not going to ruin my life.
Yeah.
You know.
So, and by defensive, you mean you're a little more cash heavy, putting them in like
cash
1 month
heavy.
rolling treasury.
I haven't got into, like, maybe the next time we talk, I'll be more into shorting and have a couple short ideas. So, but like, I haven't really got into shorting or put plays yet. The problem was I almost had a nervous breakdown in 2022 because I was in and out of options. And so basically I don't want to get heavy into that again, because when they were raising rates in 2022, I was convinced the market was going to crash. The market went down 25%, but it didn't crash. And I don't want to do that again, because it's not worth it for what it does to your health. You know, so I'm just going to do a couple plays as hedges, and that's it. And by the way, I'll still be invested. I'll still have my silver plays, but the idea is, you know, you're underweight, and then you do a couple hedges, and hopefully like Warren Buffett, or not Warren Buffett, George Soros in 2008, he wasn't one of the big short guys, but he made 1% because he was so hedged. Mm-hmm. So making 1% when the market dumps 40 or 50 is pretty good, you know? Yeah. So like that's kind of what I would like to do. And like I said, I'm not someone who worries about if I underperform the market for 6 months.
Yeah. Okay, cool. Well, thank you very much, David. We will put your links down in the show notes below.
Yeah. So, and by the way, for anyone, because I do have a pay version, and I'm going to set up a Substack for Stock Chart of the Day. All these kind of questions, My Patreon's only $7 a month, and the Substack will be a little more in depth, be like $27 a month. And you can ask me questions personally if you sign up. So I have to promote a little bit.
Of
So,
course.
yeah, sure. Thank you very much. It's actually one of the most detailed interviews I always do, and I always enjoy it.
Good. Yeah, the pleasure's all on this side of the table. And if you want to support the show and future content like this, there's a link in the notes below. You can try out TradingView for free. There's a link in the pinned comment below. And thank you for tuning in. Hit the like and subscribe, and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about AI stocks. You have yourself a great rest of the day, and we will talk to you next time.